Have you started?
Yes, ma'am. We are live. We are streaming live.
Good afternoon. Shall we start? Now, we have already discussed 2 chapters. Chapter 3, Advanced Capital Budgeting Decisions, and then Chapter 5, Security Valuation. Security valuation, we did bond and equity. Now today, we will be starting with portfolio management. So the first thing we have to discuss is what is portfolio management? What is portfolio management? Portfolio management is a systematic, continuous, dynamic, and flexible process. Any management, we know it's a process. What do you mean by a process? A process has 3 things. You input something, then there is some work done, transformation happening, and you get an output, which is what you want. So what is portfolio management? Portfolio management is a systematic. You need to do it in a structured manner, not in a haphazard manner. Then continuous. It is not that you will do it one time and then stop. No, it has to be continuous. Dynamic. It is not static. There are so many changing variables, moving variables. Therefore, it becomes necessary for us to have a process which is responsive and flexible. Since you have to respond to a dynamic situation, you can't be rigid. You have to be flexible. Okay, any process will have steps. What are the steps for portfolio management process? What is the first thing? Now, normally, whenever I address students on this subject, advanced financial management, see, I handle advanced financial management, strategic management, and strategic cost management. Basically, you can look at it as all decision-making subjects. That is what I am interested. Now, whenever I ask students, what is the first step in portfolio management? Immediately, their response is that we need to select the securities. Now, is that the first thing we have to do in portfolio management? No, because let us say you have money and you want to construct a portfolio. I have money and I want to construct a portfolio. Can we do it the same way? Can we have a plan, a portfolio management that will fit everyone? Definitely not. Therefore, there are various steps which we need to have. The first one being, we need to specify the objectives, constraints, and frame an investment policy. Now, always we know for any decision, we need to have a policy. What do you mean by a policy? What do you mean by a policy? Yes, What do you mean by a policy? A policy is a framework where you have a set of guidelines for taking decisions. Why is it better to have a policy? For three things. For convenience, for clarity, and for consistency. Now, when you are looking at decision making, you are interested in having clarity as to what you are going to do. And supposing similar situation, you want to take a decision, it should be convenient for you. You have to make it fast. So if you have a policy, it is easy. And then consistency. You cannot keep changing. There should be consistency in what you're deciding. And therefore, for these three things, we need a policy. As far as financial management is concerned, there are three decisions which we take in financial management. What are those three decisions? Financial management. So, first of all, I need to have finance to be able to manage it. So I have to source. Then, when I source funds, there is a cost involved. Therefore, funds which have been sourced cannot be kept idle because source the funds has cost. So I need to invest in order to get a return, which means investment decisions. Then obviously I will decide to invest in those proposals where the return is more than cost, which means I have a surplus. The third decision would be what I will do with the surplus. Will I retain it for investment in the business, or will I give it back to providers of capital? So in financial management, we have three decisions: financing decision, investment decision, and dividend decision. Of course, all three are interrelated. Your sourcing decision will influence your investment because that only tells you how much money you have. That only tells you what is the minimum return you should get. Your investment decisions influence your financing decision because investment decision, you know how much you have to invest, accordingly you have to source. Also, if you have retained earnings, it is not necessary for you to again raise capital. So it will influence your financing decision. And dividend decision again is influenced by your financing decision, your investment decision, and in turn influences the other two. So we have three decisions: financing decision, investment decision, and dividend decision. For each of these decisions, we have a policy. For investment decision, we have investment policy. For financing decision, we have financing policy. For dividend decisions, we have dividend policy. Similarly, now I have to make an investment in portfolio management. Therefore, I have to have an investment policy. This investment policy, I have to consider two things. What are the two things I will consider for this investment policy? One, the objective. Different investors will have different objectives. Not all investors will have the same objective. What all objectives can you have? You may first look at yesterday when we were discussing bond also, we discussed that the first interest for an investor is capital protection. Therefore, here also your objective would be security and safety of principal. Then some investors may depend on their investment for their income. So stability of income could be an objective. Some may not require their money immediately. They might be interested in investing for a long term and they do not look to any return from these. It is also a possibility. So capital growth. Then some might like to exit whenever they want, market it. Then you are interested in the holistic or overall picture. Therefore, I want to see that the return and the risk are balanced and I have an optimal portfolio. So diversification. Now you will find some of the investments, that is the tax saving investments, are done in the month of March. Why? Because tax savings, tax advantage, they want it. So what do we know? There are various objectives. These objectives will be different for different investors. Therefore, first of all, before having a portfolio, I need to be clear as to what are the objectives. So specification of objectives. Then different investors will have different constraints. Before I frame the investment policy, I have to look at the objective. I have to look at the constraints. The objectives have to be framed. The investment policy has to be framed in the context of constraints. What constraints we have? Liquidity, the time period, time horizon, tax status, legal, regulatory considerations, those things. Now, objectives have been specified, constraints have been understood. Then we are ready to frame the investment policy. So, an investment policy specifies the action to be taken. What should I do for making this investment? An investment policy is a policy statement. What does it do? It helps the portfolio manager. In what? In managing an investor's portfolio. In considering what we have already discussed, the objectives and constraints. Since the objectives and constraints for different investors are different, the investment policy will also be different. Okay, now we are ready. Investment policy we know. So straight away can we invest in the securities means? No. Before constructing the portfolio, there is yet another step which we have. What is it? I need to analyze the macroeconomic situation. So macroeconomic analysis I have to do. What is it I should do? I should look at the macroeconomic variables relevant for assessing the risk and return characteristics of each asset class. I have to find out the various asset classes I have. What is the macroeconomic expectation in the forthcoming period? And then I have to analyze and find what is the risk and return characteristics for each asset class. So expectations regarding these variables would be found. The risk and return for major asset classes. What are all the asset classes I have? First, liquid cash, cash and cash equivalent is an asset class. It's already in the most liquid form. Then I have bond, fixed interest securities. Then I have equity. Then I have real estate. Then I have alternative investments. So essentially, we can look at 5 asset classes: cash and cash equivalent, fixed interest securities, equity, real estate, alternative investments. You even consider commodity as a separate category and not put it under alternative investments. So based on how you are looking at it, you could have many more asset classes also. Essentially, I am telling you what are the main asset classes which everyone would consider. Next. Now, I have specified the objectives. I have found the constraints. I have framed the investment policy. I have done macroeconomic analysis to see what is the return and risk of various asset classes. Now, what do I do? Next, I'm interested in portfolio construction. Now only I'm coming for portfolio construction. What do I mean by portfolio construction? Portfolio construction means asset allocation policies and procedures. Just now we saw I have 5 major asset classes: cash and cash equivalent, bond, equity, real estate, alternative investments. So in each of these asset classes, the money which I have, how much am I going to in each asset class? So what is the policy? Asset allocation policy. Asset allocation policies and procedures. So what decisions should I make? First, the asset class in which I want to make an investment should be decided. Based on what? Based on my investment policy and the macroeconomic analysis. I should decide on the asset class. Then what should I do for each asset class? What is the investment amount? That is what I should decide. The amount of money to be invested in each asset class should be decided. Okay, I have done that. Then what actually is the investment I'm going to make? And let us say you have decided you are going to invest in metals, precious metals, which is the one that is skyrocketing now, the price, gold. Let us say you are interested in investing in gold. Investing in gold can be done in many ways. You can invest in physical gold. You can invest in e-gold. You can invest in government gold sovereign bonds. You can invest in gold ETF. You can invest in equities of jewelers. All this is investment in gold. Correct. So you have to decide which one, where you want to invest. Then for each of this, what is the amount of money to be invested? That also has to be decided. Is it clear? So what have we seen? What is the first step? Specification of objectives, constraints, and framing an investment policy based on the objectives and constraints. Then macroeconomic analysis to analyze and assess the return and risk for each asset class. Major asset classes, we said we will have 5 in number. Then portfolio construction, that is asset allocation, policies and procedures. What are the decisions to be made? The asset class, the investment amount in each asset class. What you have decided, the asset class which you have decided, you will make the investment. How, what you will make the investment. That is why we took the example of gold, where we said we can look at investing in physical gold, e-gold, sovereign gold bond, gold ETF, gold mining companies, gold traders, jewelers, anything you could have decided. Then for each of this, what is the amount to be invested? That should also be decided. Now only we come to our chapter heading. So before portfolio management, so many things have to be done. Okay, now we come to portfolio management. See, before I manage a portfolio, I need to construct it, isn't it? So for us, the first thing is objectives and constraints and framing an investment policy. And the next thing is, what is the next thing we'll do? Macroeconomic analysis. Then portfolio construction, where you look at the asset allocation, policies and procedures, where each asset class, how much, and there what type of asset you are going to, that you have decided the asset also. How are you going to invest in that asset? And then for each of this, what is the amount? Now, having done that, we are looking at portfolio management. Portfolio management, I have to do by adopting a suitable investment strategy. What kind of strategies can I have? I can have active strategy or passive strategy. What is active strategy? The objective of active strategy is to outperform the market with superior returns. So, what is the aim of an active portfolio manager? You want to exploit market inefficiencies. You will purchase securities that are undervalued and sell securities that are overvalued. So you will keep on, you'll be at it all the time. You will purchase and sell securities aggressively. You will change the asset mix frequently. All this you will do. Then, because you are under pressure to generate returns, you will get involved in speculation, short-term trading, all that you will do. This is active strategy. What is the other strategy? Passive strategy. The objective of passive strategy is to reduce risk. I am not interested in outperforming the market. When I follow passive strategy, if the objective of active strategy is maximizing return, the objective of passive strategy is to minimize risk. Any investment, I can only look at two things, return and risk, before making an investment decision. The two main factors to be considered are return and risk. So, next, passive strategy. Active strategy, we have to consider two things, return, risk. I can choose between the two. Do I want to maximize return or do I want to minimize risk? What is it I want to do? Let us say I want to maximize returns. I want to generate superior returns. Then follow active strategy. Passive strategy, no, I'm conservative. I'm okay if I don't get very high returns, but this should be less. Therefore, I will follow passive strategy. Now, passive strategy does not aim outperforming the market. It aims at reducing the risk. Therefore, in passive strategy, what is involved? Diversification. So, selecting a large number of securities to reduce risk that I am interested. Then, saving transaction costs. Active strategy means forever I will picture on my portfolio. Passive strategy means as long as I do my homework, I need not be actively involved in always churning my portfolio. So every time you make a purchase or a sale, you incur transaction cost. If you follow passive strategy, you will have less cost, less transaction cost. You will save on transaction cost. Then always the benefit of investing long term is the benefit of compounding. So with this portfolio management, so is that enough? Is portfolio management over? With this, is portfolio management over? No. I need to monitor it. I need to revise it if need be. So whether you follow active strategy or you follow passive strategy, it has to be continuously monitored. If necessary, it has to be revised. Why? To ensure that the portfolio remains appropriate. You already saw portfolio management itself is a systematic, continuous, dynamic, and flexible process. So, since you have to stay relevant, you will have to continuously monitor and revise based on your strategy. If necessary, you will revise. The portfolio has to remain appropriate in an ever-changing environment. So what can change? Why is it necessary? I have to revise what can change. Now, when you say you're making an investment, three things are involved, or three parties are involved. Who are the three parties? One actually is a party, a person, the investor. Two, the investment itself. And three, wherever you can transact, the market. So the factors that can influence, that can change would be one, the investor. What can change with regard to the investor? With regard to the investor, the objective can change. The constraints could change. Then investment. What can change with regard to the investment? The risk attributes, the return prospects of the investments which I have made, that could change. Then market. In the market, there could emerge new investment opportunities. So all this I need to consider. Now the portfolio manager must monitor these changes and respond by rebalancing the portfolio to accommodate these changes. So with this, can I say everything is over? No. Then also it is not over. What should I do? See, I have done so many things. Objectives, constraints, investment policy. With all this, I framed the investment policy. Then what did I do? Macroeconomic analysis I do. Then what do I do? The allocation policies and procedures. Then what did I do? I developed a strategy, decided I will have that. Then portfolio monitoring and revision. When you monitor, you are observing whether any of the things are changing for these three things that you have done. Then finally, what should I do? I have done all this work. Is it working as planned? Is it achieving its objective? That I have to say. So evaluation of portfolio performance, that is necessary. So this step involves measuring the risk-adjusted performance of a portfolio. The risk-adjusted performance of a portfolio in order to evaluate the investment strategy which you have developed. You want to evaluate the portfolio performance. Is it getting you the desired result? Whatever you wanted to do, are you able to do? That is what we are seeing. Then, what is the next thing? I'm interested in finding out the risk. Now, portfolio risk is determined by how many things? 3 things. What are those 3 things? I'm looking at portfolio risk. The portfolio consists of securities. So, risk of the securities will tell me what is the risk of the portfolio. Is that enough? No. Weight of each security in the portfolio. How much the investment or security can influence the risk. How big it is. That I have to see. Then I also have to look at the correlation that exists between every pair of securities in the portfolio. The correlation that exists between every pair of securities in the portfolio. Now, what have I understood? Portfolio return is the weighted average return of the individual securities that constitute the portfolio, where the investment proportion of each portfolio I will take as a weight. So, risk of the securities in the portfolio, weight of each security in the portfolio, correlation that exists between every pair of securities, all this I will consider. So, what is my conclusion? The risk of a portfolio is not the weighted average risk of the individual securities that constitute the portfolio. So, portfolio risk I have to consider. For risk, you know that for return we will take expected return, for risk we will take standard deviation, or if need be, we will take something else also. It depends on what is our objective, what is our situation, what we do. Based on that, we could have many different concepts of risk. Next, we will come to the one which we are very much interested. Whenever I do this, what is the one I'm interested? I'm interested in CAPM. What is CAPM? CAPM is Capital Asset Pricing Model. What is a capital asset? A capital asset is an asset which is held for the purpose of generating return. Assets can be categorized as real assets, intangible assets, financial assets. Real assets are physical assets. They have valuable properties, and because of that, they command a value. So precious metals, land, real estate, commodities, all this. These are real assets. Then intangible assets are valuable property that are not physical in nature. Then your patents, trademarks, intellectual property, all those things come into this. What we are interested in, a financial asset. What is a financial asset? A financial asset is an asset that derives value from a contractual right or claim. So it is an intangible representation of the monetary value of a physical asset. The document as such does not have any fundamental value unless it is converted into cash. Financial assets, they do not have any physical worth. They may not even have any physical form. Their value reflects factors of supply and demand in the marketplace. Now, what do we consider as financial assets? Cash, cash and cash equivalent, equity. If you have a contractual right to receive some money, if there is a contractual right to exchange financial assets and liabilities. Now, in addition to all this, now we are interested in what is known as capital asset. Capital asset, you would have come across in accounting, in income tax, etc. Here, in the context of financial management, what is capital asset means? Capital asset refers to any asset used in generating return. It is not for personal enjoyment. It is not for consumption. It is not for aesthetic taste. All this is capital asset. So, up to this, are you okay? It is always better whenever we learn something. It has to be thorough. There should be a thorough conceptual understanding. So, till now, what have we discussed? We discussed what is portfolio management. What are the various steps in portfolio management? We also discussed what is an asset. We discussed what is a portfolio, what constitutes portfolio risk. Portfolio return, of course, is the weighted average return. Risk is not the weighted average risk. So this is what we were discussing. And then, now, let us move on to diversification. Already made a passing reference to diversification. What is diversification? Diversification is a risk management technique. Now, if you have a variety of instruments within a portfolio, the objective is to reduce the risk of the portfolio. When you talk about a variety of investments, many of them might have risk, but a portfolio with a variety of instruments will have a lower risk than any individual investment found in the portfolio if you have constructed properly. So, diversification is a risk management technique. So, up to this, are you okay? Next, we will move on to a favorite, which is CAPM. What is CAPM? CAPM, Capital Asset Pricing Model. So, the Capital Asset Pricing Model, it was developed by William Sharpe, Jan Mawson, and John Whitman way back in 1960. So, the idea or the basic premise on which you have CAPM is that the diversifiable risk of a security is eliminated in a well-diversified portfolio. Now, here, systematic risk cannot be diversified, but unsystematic risk can be diversified. Then we have the CAPM model. This is what you know regarding a Kaplan model. So study this. Let's see what does it indicate to us. Now, this is a model which gives you the risk adjusted discount rate. RS is the required return. Required return means risk adjusted discount rate. RF, we already discussed yesterday also. RF, the risk-free rate, stands for risk-free rate, nominal risk-free rate, which you get from government securities. They are considered to be default risk-free. Now, beta is a sensitivity factor. RM is a return from the market. RF is a risk-free rate. RM minus RF gives me the market risk premium. So this is what we have in capital asset pricing model, most important model. Like for valuation, we said Gordon's model is the most important model. For this, whenever we are looking at cost, whenever we are looking at required return, then CAPM is a very important. Now, already when we discussed, we said when an investment is made in a capital asset with the objective of generating return, there are three possible outcomes: certainty, probability, and uncertainty. Certainty meaning only one outcome is possible, no variation. So there is no risk, there is no uncertainty. Two, probability, range of outcomes or return is possible. The probability of each outcome is assessed objectively. In such a situation, the risk associated with the return can be measured objectively using statistical techniques. Now, what can be measured can be managed. That's the idea. Risk management itself, what is it we have in risk management? The first thing is risk identification. After risk identification, what do we have after risk identification? Risk measurement. After you have measured, what should you do? Once you measure, you are looking at managing it. Managing it means what? You have an acceptable level of risk. You are in business. You know that you need to undertake risk. You have an acceptable level of risk. Now, if you bring a risk within the acceptable level, that is risk management. So in risk management, what do we have? In risk management, what we have is one. What is the first one? risk identification, then risk measurement, then deciding on the maximum acceptable level of risk, then managing the risk within the acceptable level with the least possible cost. Is it clear? So this is what we have. And the return of a security, we know, is made up of two components. We discussed this yesterday also. Income, capital appreciation. Income based on the investment, it could refer to interest, dividend, etc. Capital appreciation, always closing price minus opening price. The return of a portfolio can be computed as one. I could take the total return from the portfolio, divide by the total investment in the portfolio, and multiply by 100 because I want it as a percentage. This method gives me the return for the portfolio as a whole and not individual securities. Okay, then what can I do? I can use weighted average return and find portfolio return. Then I can use CAPM and find portfolio return. The required return using CAPM can be considered as the expected return if all the assumptions under CAPM are fulfilled. Next, what we will do, we will take up a problem. A problem which is a combination of our capital investment and portfolio management. You know, risk adjusted discount. I was just mentioning that even CAPM can be used to find the risk adjusted discount rate. That is what we discussed. So we will take up a problem where CAPM is used to find risk adjusted discount rate and then evaluate an investment portfolio. That is what we are going to do. Let's take it. Now, always we are interested in solving the problem. The first thing we should do is to read the requirement. They're asking which technique is better, which means more than one technique is being considered. This is a unique problem where capital investment, your third chapter, and portfolio management both have been combined. Which technique is better? Okay. Pastel Limited is considering two major new investment opportunities. Project 1 and Project 2. Each project would require an immediate outlay of 10 lakhs. So we find that they require the same initial investment and would generate cash inflows at the end of the year. Pastel Limited expects to have available resources to undertake only one of them, meaning they are mutually exclusive. They are going to take only one of them. The directors of Pastel Limited believe that Returns from existing activities and from the new project will depend on the economic environment prevailing during the forthcoming year. They estimate the cash inflows and probabilities. They give you what is the probability, what is the cash inflow, what is the cash inflow for project 1, for project 2. Then existing activities also they have. The investment in existing activities amount also given, risk-free rate is also given. The directors have decided to use CAPM for appraisal of their 2 projects. Advise the company regarding selection of the project using net present value and internal rate of return. I'll give you some time for you to try, then we can discuss. As I was mentioning yesterday, day before now, we need to first have the practice of solving on our own. That will help us in identifying any mistakes which we are making. The idea should not be to just note down the solution. Just now we discussed your return consists of 2 components, income and capital appreciation. So how do you find the return? The first thing is to find expected return. How do you find it? You need to find beta also if you want to use CAPM. If you want to use CAPM, beta is the main thing. How do we find beta? Now beta can be found. You need 3 things for finding beta. 1, correlation. 2, standard deviation of the security. 3, standard deviation of the market. Is this clear? Now, we need to know what is meant by correlation. Now, we are using different terms, variance, correlation, covariance. Now, we need to know what these things mean. How to find correlation? Now beta, there is another formula which we can use also. Correlation is found as covariance between the security and the market divided by standard deviation of security into standard deviation of the market. Now correlation I have expanded into standard deviation of security divided by standard deviation market remains. This and this get cancelled. So beta coefficient, another way of finding would be covariance between the security and the market divided by variance. This is another. How do we go about finding these? Now, first of all, how can I use CAPM, which is for investment in the capital market, for capital investment, which is investment in the business? We will see that. In place of the security, we need to take the projects or the proposal. Instead of the market, we should substitute with existing projects. That is all the difference. Now, let us look at this problem. What do we observe in this problem? What do we observe in this problem? It would generate cash inflows at the end of the year. It would generate cash inflows at the end of the year. So what is the life of the proposal? 1 year only. So life is 1 year. There is no question of income and capital appreciation. There's no income, we have only capital appreciation. So first of all, we need to find the return. How to find the return? How do we find the return? Now, return here has only one of the components, namely capital appreciation. There is no income part. So I will take what is the year-end cash inflow, deduct the year beginning cash outflow to arrive at return. Then return should be used as a percentage, find out, multiply with the probability, get the expected return. This is for project 1 and 2, and which are like the securities which we do when we do in capital market. Apart from this, what you have is market. Existing projects will take the place of market. So year-end cash inflow minus year beginning cash outflow is the return. What is the return percentage? What is the probability? What's the expected return? For project 1, what it is? For project 2, what it is? Then you need to take existing activities as market. For that also, how much it is? Yes. What have we done? We have taken the year-end cash inflow, deducted the year beginning cash outflow to get the return. We need return as a percentage. So the return divided by initial investment or year beginning cash outflow will give me return percentage. I multiplied with the probability and then found the return. So this is done. What should I find now? I'm interested in finding beta. So now, what am I doing? I already had the return for the 3 situations given. Multiply with the probability, get the return for project 1, return for project 2, and return for project this existing projects. We already saw for computation of beta, we need covariance and variance of existing activities. So that we understand. How will we find the variance? First, we know that existing activities has taken the place of market. Therefore, the environment, the probability, the return into probability. Here I've taken it as a decimal instead of a percentage. Then what is the deviation? The square deviation into probability, get the variance. Now finding covariance. We need covariance of project 1 with existing activities and covariance of project 2 with existing activities. For variance, we use only one security or market and then square the deviation. For covariance, we will take the deviation in one, the deviation in the other, multiply. Now we have to be more careful while computing covariance because of the sign. For variance, anyway, we are going to square, so the result will be positive, which is not the case for covariance. Therefore, we have to be careful when we look at the computation for covariance because it involves negative. Then covariance of project 2 with existing activities. Now once this is done, beta. Beta is found as covariance between project 1 and existing activities and variance of existing activities. Now, if you look at the requirement of the question, it says the directors have decided to use CAPM for appraisal of their 2 projects. So we should find what is the required return using CAPM. RF plus beta into RM minus R. With this, you need to use this as a discount rate. It stated that the directors have decided to use CAPM. Advise the company regarding selection of the project using net present value and internal rate of return. So we need to find net present value and internal rate of return. We are interested in using net present value and IRR. IRR is the rate of return which a proposal yields. We already found the rate of return to be 16%. Required return using CAPM we found just now. So the excess of expected over required will be the basis for the ranking. Next, we are interested in net present value. Using net present value, how do we find? We know the expected cash inflow to be 11,60,000. So now, CAPM, that rate has to be used as the discount rate. So you will find present value of cash inflow as future value of cash inflow divided by 1 plus R. So we have ranked the proposals using NPV and IRR. Now, when we go to the question, the requirement of the question is advise the company regarding selection of the project using net present value and internal rate of return. Now, first of all, net present value and internal rate of return, will they give us the same decision advice? That is what we have to see. Will they give the same decision advice? With regard to net present value and IRR, both will give the same decision for independent investment proposals involving conventional cash flows for the same time period. They will give conflicting decisions for mutually exclusive investment proposals which have the following attributes. What attributes? First is size disparity. That is, proposals involve different capital investment. NPV measures the absolute increase in value. IRR is the rate of return on investment. That is, it is a relative measure. An absolute increase in value is preferable to higher rate of return on a lower investment. Hence, NPV should be preferred over ARR. Then, time disparity. That is, the proposals have different pattern of cash inflows. Both NPV and IRR, they assume that the cash flows generated by a proposal are being reinvested. But there is a difference in assumption regarding the rate at which it is being reinvested. In case of NPV, it is presumed that the cash flows generated by a proposal are reinvested at the cutoff rate. On the other hand, IRR assumes that the reinvestment of interim cash flows in projects with equal rates of return. Therefore, IRR overstates the annual equivalent rate of return. Now, for high-yielding proposals, it is difficult or rather impossible for you to find other proposals giving you the same high return. Therefore, the assumption under IRR is unrealistic. Then age disparity, then also there will be a difference. The proposals have different lives. So while evaluating proposals with different lives, NPV should be modified to find equivalent annual cash flow. Now, internal rate of return is an indicator of the efficiency and quality of yield of an investment. Net present value is an indicator of the magnitude, and therefore NPV is a more accurate reflection of what is value to the business. Because ultimately, the objective of financial management is maximizing the value. IRR should never be used to rate mutually exclusive proposals. So, shall we move on to the next problem? Now, calculate the average return from the portfolio for the year ended 31/3/60 Calculate the expected average return from the portfolio for the year ended 31/3/70. Advise X company of the comparative risk in the two investments by calculating standard deviation in each case. Mr. X invested in certain equity shares, 2 equity shares he is investing. Number of shares, what is the cost? So there is a dividend paid and market quotations are given. The expectation for the future year is also given. Calculate the average return from the portfolio for the year ended 16, for the year ended 31/3/70, and comparative risk, that is standard deviation you have to complete. Please try. I'll give some time for you to try. Now, how do we go about solving this problem? First, we need to do for the year 15/16. Calculate the average return from the portfolio for the year ended 31/3/16. So, for 15/16, what is the return? Again, here, we know return is made up of 2 components, income and capital appreciation. So consider that. Find the answer. What is the cost? How many shares? Therefore, what is the price? What is the capital gain? What is the dividend? What is the return? Return as a percentage, investment proportion, portfolio return. So now we have found the return, actual return for the first year. Next, we need to find the expected return for the next year, forthcoming year. For that, let us find the expected price. Expected anything, various outcomes multiplied by the probability. Now, once we have the expected price, let us find out what is the expected portfolio return. The point to be noted here is when we find the return for 16-17, we need to take the beginning value in 1416 to find out what is the opening value, because we are finding the return for 16-17. So when we find the expected capital gain or loss, it should be the difference between 31,317 and 1416. And when we apply the proportion also, investment proportion also, whatever value we had at the beginning of 16-17, that will be the investment proportion. So now we have the expected return for the forthcoming year. There are many reasons why 15-16 and 16-17 should not be combined. First is 15-16 is actual, 16-17 is expected. Those two cannot be combined. Second, whenever we give return, we need to give an annual return. Now, we already found the expected price, standard deviation of price for M. We know that standard deviation takes the same unit as the base data. Therefore, this standard deviation will also be in rupees only. as a percentage, how much it is. This is for M. The same thing we should do for N. X minus X bar. We know X is 220, X bar is 253, therefore minus 33. Like that. Similarly, for N, so is this done? Now coming to evaluation, it stated you need to find the expected return and also the relative risk using standard deviation as a measure of risk. So are you through with this? Till this, are you through? So now, whenever we are discussing portfolio management, there is a confusion as to what is the difference between variance, covariance, correlation, beta. Are these different things? What is the difference? When we talk about variance, we consider the movement or change in one variable. The direction is not captured. So variance is about the movement or change in one variable, and direction we do not consider. What is covariance? Covariance is the movement or change in two variables. Direction is captured. That is why I said when we are computing covariance, you have to be careful about the sign. Next, correlation. What is correlation? Movement or change in two variables. Direction and strength are captured. See, you find that each one is an improvement over the other. And then when you talk about correlation, there are three possible scenarios. You could have zero correlation. You could have perfect positive correlation. You could have perfect negative correlation. And you could have strong correlation, weak correlation. What is the range for which we will consider all this? We will see. Now, zero correlation. What does it mean? The two variables which you are studying, they are not at all related. The variables are not related. Only when you have a non-zero correlation, you can say that the variables are related. How they are related? There can be a situation where you have a perfect positive correlation, which means correlation should be +1. Or you could have perfect negative correlation. A correlation coefficient of +1 means that the two variables are perfectly directly correlated. If one goes up, so does the other. The change in one is a multiple of the change in the other. Perfect negative correlation. A correlation coefficient of -1 means that the variables are perfectly inversely correlated. If one goes up, the other comes down. The growth in one is a negative multiple of the growth in the other. Unless the coefficient, the correlation coefficient, is +1 or -1, there are other variables influencing the relationship. It is not just this, there are other variables also. It is the meaning. The closer the correlation is to 1, higher the level of confidence, because stronger is the relationship. The closer the correlation coefficient is to 0, lower the level of confidence, because lower the relationship. The strength is not that much. So how do we decide what is the strength? We said correlation will capture the strength. It is about movement or change in two variables. It will capture the direction as well as the strength. That is what we saw. How to decide? So now, +1, 0.8 to 1, strong, 0.6 to 0.8. 0.8 to 0.1 means very strong, 0.6 to 0.8 means strong. Similarly, these are the ranges where we say whether it is strong, moderate, weak, very strong, all that. Now, apart from this, what is beta? Beta, again, is about movement or change in two variables. The direction is captured. Not just that, the magnitude is also captured. So here again, you can have three possibilities: positive beta, negative beta, zero beta. Positive beta means the security returns. Supposing we are looking at positive beta between the security and the market. Positive beta means the securities return generally follow the market return. They both tend to be above their respective averages together or below their respective averages together. Negative beta, they move in the opposite direction. Zero beta, they change independently. Security that has beta of 1 shadows market movements. It has identical risk as that of the market. An investment that has a beta of less than 1 is less risky than the market because it softens the impact of changes. An investment that has beta of more than 1 is riskier than the market because its changes are more than that of the market return. So, are you clear with the differences between variance, covariance, correlation, beta? Normally, students have a confusion. What is the difference between these? What is the difference between variance and covariance? What is the difference between correlation and beta? So they have that kind of a confusion. Is that clear? Now, let's move on to the next. Now, systematic risk and unsystematic risk. What is the regression equation for the above returns of Zenith and index? Find total variance for Zenith and indicate how much of that is explained and unexplained by index. So for Zenith and market for a 5-year period, that is given. Now, before we get into this, we need to know what is risk. What are the different kinds of risk? What are the different types of risk that we need to know? What is risk? Risk is the possibility that the actual return is different from the expected return. What is risk? Risk is the possibility that the actual return is less than or is different from the expected return. Risks can be classified into systematic risk and unsystematic risk. What is systematic risk, also known as portfolio risk? Systematic risk comprises of factors that are external to the company. These are risks associated with economic, political, social, environmental, or macro level changes. Now, due to the dynamic nature of the economy, changes keep occurring in the economic, political, social, legal, all these conditions. These changes influence the performance of the company. So, if the performance of the company is affected, then the price of the company is also affected. Systematic risk affects the entire market. It cannot be controlled or eliminated. It cannot be eliminated by diversification. Even investors hold a well-diversified portfolio, they are exposed to systematic risk. The degree to which different portfolios are affected by these systematic risk is different. And this is what we measured in beta. We discussed beta just now, isn't it? Where correlation into standard deviation of security divided by standard deviation of market, or we said covariance between the security and the market divided by variance of the market. Now this beta is what we are referring to. There are various kinds of systematic risk. Market risk, interest rate risk, purchasing power or inflation risk, liquidity risk, regulatory risk, political risk, exchange rate risk. All these are systematic risk. The next classification is unsystematic or security risk or company specific risk or industry risk or unique risk. So many different names for the same thing. Unsystematic risk, security risk, company specific risk, industry risk, unique risk. What is this? These are about factors internal to a company. This risk pertains to a company's business, its operations, its finances, its business risk, its operations, operating risk, its finances, financial risk. So these risks are unique for the company or for the industry. So unsystematic risk, can it be controlled? Yes, they are controllable by nature and they can be reduced significantly by sufficiently diversifying funds portfolio. So unsystematic risk can be avoided through diversification. What happens when a large number of securities enter a portfolio? Many random fluctuations in return from these securities will automatically set off each other. So kinds of unsystematic risk. You already saw business risk. How will you manage that? Strategic management. And financial risk. See, as an investor, to protect against business risk, investment should be made in stable stocks, not cyclical stocks. Cyclical stocks are stocks which belong to some industries, certain industries, such as automobiles, construction and durable goods. These are cyclical stocks. The earnings of such companies move directly up and down with expansion and contraction of the economy. So that is business risk. Financial risk. What is financial risk? What is the capital structure of the company? What is the financing adopted by the company? Now, if you have high debt, that leads to financial distress and then bankruptcy. To protect against financial risk, as an investor, he should invest in companies with low debt or low debt. Then default or credit risk. The business risk, this we discussed when we did bonds also. The business risk and the financial risk will lead to credit risk or default risk. That is, they are not able to pay interest or principal on time. So business risk and financial risk, business risk, financial risk, operational risk, all these lead to default risk, I can say. Now, management risk. This is what we would have studied at the intermediate level as agency problem. That is, the owners are different, the ones who are running the business different. Management is supposed to act in the interest of the shareholders. So when there is a conflict of interest, what they do, that is a matter we see here. Then operations risk. Then event risk. There could be some event which is peculiar to a particular industry that could lead to a risk. So this is what we have in risk. Systematic risk, unsystematic risk. So how to measure risk, how to split it into systematic and unsystematic, all that we will see after the break. Let's have a break. So welcome back. Let's continue. We were discussing regarding systematic risk and unsystematic risk. Systematic risk is for all companies or securities. Unsystematic risk or unique risk or company-specific risk or industry risk, it is only for specific securities. We also saw the different kinds of systematic risk, different kinds of unsystematic risk, and how to protect ourselves when we invest in securities against these risks. See, the one main advantage, biggest advantage of this subject is that we can use it for our own personal finances also, especially portfolio management, mutual funds. These are chapters which are applicable for personal finance. So now let us move on to question 3. What is the regression equation? What do we mean by a regression equation? What do we mean by a regression equation? Now, we need to know the concept of alpha. When we discuss regression equation, we need to know the concept of alpha. We will discuss the concept of alpha before we get into this. Alpha means excess return. Excess of what over what depends on the context. Alpha used for estimation, alpha used for decision making, alpha used for performance evaluation. So different contexts we have alpha. When we talk about regression equation, we are referring to alpha used for estimation. Regression analysis is a statistical tool that helps us to estimate the values of one variable, which is the dependent variable, with the values of another variable, independent variable. So when we talk about the market, when we talk about the security return is the dependent variable. Market return is the independent variable. We know that the return of a security is made up of two components. That part of the return that is dependent on the market. Then the return that is independent of the market return. So using past returns of the market and the security, we will find three things: average market return, average security return, beta. So alpha used for estimation, RS is equal to alpha plus beta into Rn. Alpha plus beta into Rn. RS is equal to return of the security, that is the dependent variable. Alpha is equal to return of the security independent of the market return. Then we also have beta, which we know, sensitivity of security return to the market return. Then market return, that is the independent variable. Then RM is the market return, which we have, independent variable. Beta gives you the beta into RM gives you the return of the security dependent on the market return. So this is what we have. What is it? Regression equation. What is regression analysis? Regression analysis is a statistical tool. What for do you use it? We use it to estimate the values of one. We use it to estimate the values of one variable in place of another variable. So now, when we talk about the security, when we talk about the market, which is the dependent variable? Security return is the dependent variable. Which is the independent variable? Market return is the independent variable. We have already seen, we are looking at a regression equation where we try to find out. Now you can just note down the formula. I have typed the formula for you. This is what we mean. The return of a security is characterized by three parameters: alpha, beta, and maturity. So regression equation, characteristic line, everything means the same. So have you noted down this? The next alpha we are looking at is alpha used for decision making. Now alpha in this context, see, always alpha means excess return. Excess over of what over what. That is the difference. Alpha used for decision making. Alpha in this context means excess of expected return over required return. Alpha is equal to expected return minus required return. If expected return is greater than required return, we have positive alpha, which means the investment is expected to earn more than the return required for the assumed risk. Securities with positive alpha are underpriced. It signals a buying opportunity. The expected return less than required return means negative alpha. The investment is expected to earn less than the return required for the assumed risk. So securities with negative alpha are overpriced. It signals a selling opportunity. Then three things are possible. Expected is more, expected is less, or expected is equal to. Expected is equal to required return means alpha is equal to 0. The investment is expected to earn a return just adequate for the risk taken. Securities with 0 alpha, they are correctly priced. It is a signal to hold. If they are underpriced, buy. If they are overpriced, sell. If 0 is there, then you hold the security. Next, alpha used for performance evaluation. Now, see the logical sequence. First, we need to estimate, then we need to decide, then we need to evaluate the performance. Now, alpha can be used for evaluating the performance of the portfolio managers or portfolio or even a security. So in this context, alpha is computed as the excess of actual return over required return using CAP. The performance ranking, whether it is for the security or the portfolio managers, is done based on positive alpha. Alpha is equal to actual return minus required return. Actual return greater than required return, positive alpha. Investment has given a return more than the reward for assumed risk. Securities or portfolios with positive alpha have overperformed. Now, actual return less than required return. Alpha less than 0. Negative alpha. The investment has not earned enough for the assumed risk. Securities, portfolios with negative alpha have underperformed. Actual return is equal to required return. Alpha is equal to 0. So the investment has earned a return just adequate for the risk taken. So they have performed for whatever is required as per expectation. Neither overperformed nor underperformed. So what do we know now? Alpha can be used in 3 contexts. Alpha used for estimation. Alpha used for decision making. Alpha used for performance evaluation. So alpha used for estimation is the regression equation, is the characteristic line. Regression equation, characteristic line, both mean the same. Alpha used for decision making, expected over required. Alpha used for performance evaluation, actual over required. Are you clear? Is it clear? Yes or no? So now let us try the problem. So with the past, we already discussed that alpha and beta will be estimated based on past. So with the past, try and find alpha and beta. We will frame the regression equation. We already discussed what is variance, what is covariance, what is correlation, what is beta. What should we find? We should find covariance, variance, and beta. Beta is covariance between zenith and index divided by index variance. Index, market, everything means the same. Index, market, whatever term the problem is using, same thing you can use, but they mean the same. Index or market mean the same. Now, subsequently, for framing the regression equation, we need variance of zenith also, because we have to find something else. So now itself, you find that also. Systematic, unsystematic, to split that we require. So you please find that also now. I will give you the format in which you need to work it out. You can try, then we can discuss the answer. So, index is the independent variable, therefore x. Zenith is the dependent variable, therefore y. Dx, dy, dx, dy, sigma dx, dy, dx squared, dy squared, sigma dx squared, sigma dy squared. Please try, then we can discuss. So I can solve this. Now, hope you have completed this. So, check up your answer, please. What have we done? The return which index has had in the past 5 years, we have taken. We have found the mean. If it is for future, we will multiply with the probability and add. If it is past, we will add and then divide by the number of years. If it is a probability distribution, sigma px. If it is past, then sigma x by n. Similarly, for Zenith, what is the deviation for index? What is the deviation for Zenith? We want the covariance, so dx dy, of course, divided by n. We want the variance, so sigma dx by r divided by n. Probability means we will multiply with probability. Actuals means we will divide by the number of years. Till this, are you through? This is done. So let's say you have found this. We have the covariance, we have the variance, so we can find beta. So once we have beta, regression equation, we know is alpha plus beta into Rm. Alpha, we know y is equal to alpha plus beta x. If alpha will be y minus beta x. So we find alpha. The characteristic line of zenith or regression equation of zenith would be alpha plus beta into Rm. Rm is the independent variable represented by x. Rs is the dependent variable represented by y. So now this is done. The next requirement, find the total variance for Zenith, which we have already found. Whenever we saw this even when we did advanced capital budgeting, whenever we are combining and splitting risk, we need to use only variance and not standard deviation. So find the total variance for Zenith and indicate how much of that is explained and unexplained by the index. So let us see that. Variance explained and unexplained by index. Covariance between Zenith and index, we already found that. We take it. Now always when we are finding variance, when we are finding standard deviation or covariance, better to work with decimals. So we have taken that. Variance of the index how much, variance of Zenith how much. Take the square root, get the standard deviation. Correlation coefficient. We know is covariance divided by standard deviation into standard deviation. So have that. Now we need to find what is known as coefficient of determination. That is correlation squared. So variance of Zenith, how much it is? How much is explained by index? How much is unexplained by index? As a percentage, what is the position? Now, one way of finding is this. Alternatively, we could have taken variance of the index and multiplied with beta squared. Both are fine. Okay. Is this done? Is it clear? Now, you can note down the steps to split the risk into systematic and unsystematic. Please note down. Systematic and unsystematic risk of a security. Systematic and unsystematic risk of a security. First, find total risk of a security. Find total risk of a security. The total risk of a security is given by its variance. The total risk of a security is given by its variance. Total risk can be split into systematic risk and unsystematic risk. Total risk can be split into systematic risk and unsystematic risk. Next, find systematic risk. Risk explained by the index. Find systematic risk of the security. Risk explained by the index. Systematic risk is that part of security variance because of its relationship with the market. Security variance multiplied by coefficient of determination. Coefficient of determination is equal to correlation coefficient squared. Coefficient of determination is equal to correlation coefficient squared. Or it is the variance in the security because of variance in the market. It is the variance in the security because of the variance in the market. Market or index variance multiplied by beta squared. So, two ways of finding systematic risk. One, security variance multiplied by coefficient of determination. Two, market or index variance multiplied by beta squared. Next, risk explained by index is equal to risk explained by index is equal to total variance minus variance, total variance minus variance explained by index. Putting it another way, unsystematic risk is equal to total risk minus systematic risk. total risk minus systematic risk. So let's move on to the next one. Let's look at this problem. Required. What is the sensitivity of returns of each stock with respect to the market? That is, we have to find beta. What are the covariances among the various stocks? Next, what would be the risk of portfolio consisting of all the three stocks equally? What is the beta of the portfolio consisting of equal investment in each stock? What is the total unsystematic and systematic risk of the portfolio? So, problem number 3 is about total risk, unsystematic risk, and systematic risk of a security. Problem 4 is about total risk, systematic risk, and unsystematic risk of a portfolio. Now, before we get into that, we need to look at how to find the total risk of a portfolio. The other day also, we discussed the return of a portfolio is the weighted average return of the individual securities that constitute the portfolio, where the investment proportion of each security will be taken as its weight. But the risk of a security, the risk of a portfolio is not the weighted average risk of the individual securities that constitute the portfolio. What is the reason? The reason is that the risk of a portfolio is determined by 3 factors. What are the 3 factors? The 3 factors are 1, the risk of the security, 2, the weight of the security, and 3, the correlation that exists between every type of securities in the portfolio. So, portfolio risk is determined by 3 things. We need to look at that. So, portfolio variance. We already saw when we are looking at risk, splitting and combining risk. We need to operate variance, not with standard deviation. So portfolio variance, how do we find it? Supposing we have 2 securities, we construct a portfolio with these 2 securities. How to find the variance? That is what we are seeing now. The 2 securities which we are considering are A and B. So what do? WA squared sigma A squared plus WB squared sigma B squared, but plus 2 WAWB sigma A sigma B into correlation AB. What did we discuss? There are 3 things: weight, risk, and correlation. Now, this formula is from your A plus B the whole squared. A squared plus B squared plus 2AB. WA squared sigma A squared. Only A is involved, so weight and risk. I am squaring the weight because whenever I operate with variance, the other item, the other factor also should be squared. Plus, again, only B is involved. So weight and standard deviation. WB square, sigma B square. Plus 2 WA, WB, sigma A, sigma B, correlation. Now, here, both A and B are involved. So, in addition to the weight, the risk, we also have to consider the correlation. 2 WA, WB, sigma A, sigma B, correlation. This is clear. Next, if I want the standard deviation for the portfolio, I have to take the square root of this. Supposing I have 3 securities, A, B, and C in the portfolio, it will be WA squared, sigma A squared, plus WB squared, sigma B squared, plus WC squared, sigma C squared. Again, this is for 3 securities A, B, C being in the portfolio. Again, 3 securities standard deviation means we should take the square root. Up to this, are you okay? Is it clear? Is there any doubt in this? Now, let us look at something else. Look at this. Correlation between A and B we want. What should we do? Covariance between A and B divided by standard deviation of A into standard deviation. With this, covariance of A and B is equal to correlation into standard deviation into standard deviation. These are the base things which we should know. So now we can reframe the other equation for variance. We said 2 WA, WB, sigma A, sigma B correlation AB. Instead of sigma A, sigma B correlation AB, we can substitute with covariance. So this is the advantage of using the other formula. We don't have to take sigma A, sigma B correlation AB. Instead, straight away, we can look at the covariance. So now this is done. Let us try the problem. Find beta. You know how to find beta? What is the sensitivity of returns of each stock means? You have to find beta. Please find. After you find beta, we will see the steps for portfolio risk, splitting the risk, now we know beta is correlation into standard deviation by standard deviation. We have the correlation. So what is beta? Correlation 0.6 into standard deviation of the security 20% divided by standard deviation of the market 15%. That is how we find beta for all three A, B, C. Now, if you want to find the covariance between two stocks, what we should do, we need to take the beta of the first one, multiply with the beta of the second one, multiply with the variance of the market. That will give me the covariance. Then correlation. Correlation is covariance divided by standard deviation by standard deviation. Always you need to physically work and then check the answer. Not simply note down the answer. Simply noting down the answer will not help us in any way. So now this is done. We know that for variance, we can use the formula where you take to WAWB sigma A sigma B correlation AB, or in that place of WAWB sigma A sigma B correlation AB, for sigma A sigma B correlation AB, you can use covariance of AB. Whichever way you have done, the risk, the total risk comes to now. Still this, it is clear, isn't it? Now note down the steps for systematic and unsystematic risk of a portfolio. Please note down systematic and unsystematic risk of a portfolio. There are two methods. Method one, Markowitz model. Method one, Markowitz model. Find variance of the portfolio using the formula. Find variance of the portfolio using the formula. Next, find variance of the market. Find variance of the market. Find portfolio beta. Find portfolio beta. Next, find systematic risk. Find systematic risk of the portfolio. Find systematic risk of the portfolio. That is market or index variance multiplied by portfolio beta squared. Market or index variance multiplied by portfolio beta squared. Next, find unsystematic risk of the portfolio. That is total risk minus systematic risk. Total risk minus systematic risk. This is the first method. So now the beta of a portfolio is the weighted average beta. Here we have the beta, we have the proportion, because the problem says what would be the risk of a portfolio consisting of all three stocks equally. That is what we found. What is the beta of the portfolio consisting of equal investment in each stock? That is what we are finding now. So I have found the total risk. Now I want to find systematic risk. How will I find systematic risk? Beta squared. Always when I operate with variance, I have to square the other terms. Whether it is weight, whether it is beta, whenever I operate with variance, this also has to be squared. So beta squared multiplied by market variance squared will give me systematic risk. This is total risk. This is systematic risk. Therefore, the balance is unsystematic risk. This is the first method. Okay, now let us look at method 2, sharp index model. That is method 2. So note down method 2, sharp index model. One, find variance of the market. Find variance of the market. 2, find portfolio beta. Find portfolio beta. Next, find systematic risk of the portfolio. Market or index variance multiplied by market or index variance multiplied by portfolio beta squared. Next, find variance of each security. Find variance of each security. That is total risk of the security. Next, find beta of each security. Find beta of each security. Next, find systematic risk of each security. Find systematic risk of each security. That is market or index variance multiplied by security beta squared. Market or index variance multiplied by security beta squared. Next, find unsystematic risk of each security. Find unsystematic risk of each security. That is total risk minus systematic risk. Next, square the investment proportion. Square the investment proportion of each security. Square the investment proportion of each security in the portfolio. Next, find unsystematic risk. Find unsystematic risk of the portfolio. That is total of unsystematic risk multiplied by unsystematic risk multiplied by investment proportion squared. Next, find total risk of the portfolio. Systematic risk of the portfolio plus unsystematic risk of the portfolio. Systematic risk of the portfolio plus unsystematic risk of the portfolio. Note, the total risk of the portfolio, is made up of systematic risk plus unsystematic risk. The total risk of a portfolio is made up of systematic risk of the portfolio plus unsystematic risk of the portfolio. The systematic risk of a portfolio is not the weighted average, systematic risk of the individual securities that constitute the portfolio. The unsystematic risk is the weighted average of the unsystematic risk of the individual securities. That constitute the portfolio. Hence, total risk of a portfolio is not the weighted average total risk of the individual securities that constitute the portfolio. Now let us try using the other method. Now, how do we go about doing it? First, systematic risk of securities. Market variance multiplied by beta squared will give me systematic. Then unsystematic risk. For each security, what is the total risk? Deduct the systematic risk, get the unsystematic risk. We are operating with variance here, and therefore proportion also, weight also you square, multiply, add. So now we have the unsystematic risk of the portfolio. Systematic risk of the portfolio we already found. Add, we get the total risk using Sharp index model. Okay, can I stop sharing? Are you clear? Is the whole thing clear? The two models which we have Markowitz model, we have Sharp index model. What is the difference? In Markowitz model, we find the total risk, we find the systematic risk. Total risk minus systematic risk is unsystematic risk. In Sharp index model, we find systematic risk, we find unsystematic risk. Total risk plus unsystematic risk. Systematic risk plus unsystematic risk is total risk. In Markowitz, total minus systematic gives us unsystematic. In Sharp, systematic plus unsystematic gives us total. So totally there are three things. Find any two. Third, you can easily find. Systematic risk is common for both. Markowitz means total risk using the formula minus systematic risk will give us, unsystematic risk. Sharp means systematic risk we have found, unsystematic risk we have found, we can find the total. The advantage of Sharp index model over Markowitz model is that when you have two securities, or at the most three securities, Markowitz is okay. If you have 5 securities, 6 securities, then Sharp index is better. So that brings us to the end of today's session. We did entire portfolio management today. What are the things we learned in portfolio management? We saw how to apply CAPM for capital investment decisions. We discussed what is the financial asset, what is the capital asset, what does capital asset pricing model tell us. Then we discussed about the return and risk of a portfolio. Then we discussed how to split the systematic and unsystematic risk of a security. Then we discussed how to split the systematic and unsystematic risk of a portfolio. So, is that clear? Are you comfortable with what we have done today? Let's meet tomorrow